Imagine discovering that the difference between the word will and the word shall is being valued at 95,000 crore rupees.
Yeah, which is a huge sum of money.
Right. Just to put that into perspective for you, especially if you're listening from outside India, we are talking about roughly 11.4 billion US dollars.
It's not small change.
It all turns on a tiny grammatical shift. Our mission today is to decode a decades long standoff in the banking sector, one buried in a single word.
It's a really complex web.
We're looking at a tightly argued memo written by Anil Mehta on May 11, 2026, and addressed to Yemi Agbebi, CEO of TheBloggerian.
The document shows how an obscure 1995 regulation has trapped thousands of bank retirees in an endless legal labyrinth.
We're talking about allegations of concealed evidence, massive institutional gridlock, and ultimately, like the weaponization of time itself.
The conflict scale stems from a microscopic textual shift. Our task is to assess the memo's claims impartially because that tiny change has split the entire industry.
Right? It's a huge clash.
On one side are the bank's alleged legal duties to retirees, on the other, the Indian Banks Association's defense.
The IBA claim that fulfilling this obligation would result in a literally catastrophic financial impact on the entire banking system.
Oh, we are looking at a systemic risk defense matched against a contractual right.
Right? But to understand how we ever arrived at a 95,000 crore rupee standoff, we really have to dig into the legal foundation.
Before we even touch that 95,000 crore rupees price tag, we have to see how this began. And reading the memo feels oddly like a bizarre retail dispute.
So imagine a store hands you a discount coupon. Printed right there on the paper, it says the expiration date is October 1987.
Go for it.
But then, years later, the store management reprints the coupon, accidentally removes the expiration date entirely, and makes the language even stronger.
Oh, I see where you're going.
The author argues the banks are still bound and says this is exactly what unfolded under the 1995 pension regulations.
That is a highly effective way to visualize the mechanics of Regulation 35.1.
Thanks. It's a weird situation.
It really is, because when that regulation was originally drafted back in 1995, it was incredibly specific. It targeted a very narrow window of employees.
Right.
Specifically those who retired between January 1st, 1986 and October 31st, 1987.
So why that specific window? Like what made those 2 years so special?
It stems from a pay commission update. The 1999 rule simply aligned 86-87 retirees with the fourth pay commission cohort.
So it was just a one-time baseline adjustment.
Exactly, and the language used in that 1995 regulation was that the pension, quote, will be revised.
It reads like administrative cleanup for a small group of retirees who simply slipped through the cracks between policy updates.
That was the general understanding until the 2003 Gazette Notification Amendment.
Okay, what did it say?
This is the turning point Shri Mehta flags. In 2003, the rule was amended and the 86-87 time window immediately became obsolete.
Just gone.
Suddenly, it read like an open-ended scheme for all retirees, past and future. And crucially, the wording changed from will be revised to shall be updated.
Which changes everything.
Completely. I think in legal terms, shifting will to shall isn't stylistic and it turns intent into a binding, unavoidable obligation.
Mehta goes further, alleging that the banks deliberately hid the 2003 amendment from the Supreme Court, a grave charge of obfuscation and deception.
Yeah, that's a huge claim.
The document actually states they submitted a false affidavit, claiming there was absolutely no provision for updating pensions for post-1987 retirees.
Perhaps it was a genuine misinterpretation of facts.
Perhaps, but ignoring the 2003 Gazette that made it mandatory for all is a stretch. And this is where the logic starts to slip.
Okay, let's hear it.
If the rule was crafted for a narrow window in 1995, isn't it plausible the 2003 amendment was an innocent, if catastrophic, clerical slip?
It's a fair point.
I mean, why on earth would massive financial institutions intentionally trap themselves in a legally binding, open-ended commitment of this magnitude?
It is the most logical question to ask, and the author actually anticipates that exact defense.
Oh, he does?
The memo focuses on institutional behavior, not intent. If the rule applied only to 86-87 retirees, the banks had an easy fix, yet never used it.
which was,
They should have just repealed Regulation 35.1 completely once that specific group of pensioners was settled. You close the book and walk away.
but they didn't repeal it.
No, they didn't. Instead, they actively went through the complex bureaucratic process of issuing a new Gazette notification in 2003.
Right.
The amendment made the rule broader and more liberal. A Gazette notification isn't a memo, it's an official, legally binding government statute.
So it's very intentional.
The memo argues the banks joined an open ended scheme without grasping its cost, then tried to retreat to the 1995 limits once the strain hit,
And their tactic?
allegedly withholding the 2003 amendment from the courts to make their case.
The IBA claims that updating pensions retroactively all the way back to 1995 will cost over 95,000 crore rupees.
It's an astronomical figure.
Here's where it gets really interesting. Think about that number. That is like being handed a massive 30-year overdue restaurant tab all at once.
Yes, I'd run.
You may admit you ate the meal, but paying a 30-year bill in one hit would sink any bank balance. Their claim is stark. Pay this now, and the banks collapse.
The collapse argument is the ultimate institutional get out of jail card. When liabilities surge, systemic risk, imagined or real, becomes the trump card. But Shri Mehtaji doesn't just complain about this defense in his memo, he actively dismantles it by offering historical precedents and mathematical alternatives.
Okay, like what?
His first counterattack looks at the year 2001.
Okay,
During that time, banks implemented a voluntary retirement scheme, or VRS.
to cut down on staff,
Exactly. This was a program to reduce headcount, and it required a massive, unprecedented outlay of funds to pay out all those early retirements.
which they probably didn't have sitting around.
Right. The banks went to the central government and basically said, we cannot take this financial hit in a single year without destabilizing our balance sheets.
So, how did they handle it? Did they just cancel the scheme?
No, the central government granted them a specific legal waiver. It allowed the banks to amortize the expense.
Amortize it?
Here, amortization means spreading the huge VRS cost over 5 years, much like financing a car instead of paying the full amount upfront.
So, if the government could waive rules to protect banks during VRS, why can't a similar waiver ensure retirees receive their lawful dues now?
Fair point.
He even proposes a specific installment plan in the memo, paying the arrears in 5 equal installments over 5 years, exactly like they amortize the VRS costs.
It's a very practical solution, but let's look at the math here for a second.
Even split 5 ways, 95,000 crore rupees is nearly 20,000 crore rupees a year. The question is whether these workarounds truly resolve the core stability risk the IBA warns of.
That is the crux of the matter, and it leads to what might be the author's most potent argument. He challenges the math itself.
Wait, he thinks the 95,000 crore number is wrong?
Well, the memo explicitly notes that the underlying assumptions the IBA used to calculate that figure are not even in the public domain.
We don't actually know the precise actuarial formulas they are using to arrive at that apocalyptic number.
Even if 95,000 crore rupees is the correct retroactive cost, the author notes the courts aren't stuck with a binary choice.
Meaning,
It is not a choice between bankrupting the banks today or starving the pensioners tomorrow.
right, there is a middle path mentioned proposed by Shri Mehta.
That's the RBI model. Instead of forcing arrears back to 1995, the Supreme Court allowed only prospective updating backdated to new baseline.
Meaning they only update the pensions moving forward.
Precisely, they could make the pension updates effective from the exact date that the Reserve Bank of India, the RBI, allowed it for their own pensioners.
Oh, that's clever.
Erase decades of arrears and apply updates only prospectively, and that 95,000 crore burden collapses to a fraction.
Makes sense.
It is a proposed compromise that balances the strict legal right of the pensioner to receive an updated pension with the institutional need for financial stability.
While banks model 95,000 crore rupees risks, what happens to the retiree whose pension should have been updated 2 or 3 decades ago?
That's the real tragedy here.
Look closer. And it's not just a one-off payout fight. It's a pattern of delay and hidden math flaw eroding pensions today.
The author argues that weaponized delay is the IBA's playbook, pushing legitimate rights into litigation that drags on for decades for seniors running out of time.
The examples in the text are just staggering to read. The memo cites a dispute over a dearness allowance, or a DA, merger.
The fight hinges on whether to use 1016 or 1084 points, a tiny 68-point gap that surprisingly was enough to ignite a 17-year legal battle.
The points mark the index level. With each wage settlement, that allowance is folded into basic pay, creating a higher baseline for pension calculations.
So it alters the foundation of the math. If you merge the DA at a lower point level, say 1616 instead of 1684.
So it alters the foundation of the math.
Exactly. If you merge the DA at a lower point level, say 1616 instead of 1684, you are cementing a lower base salary,
which affects everything that follows.
which completely explains why people fought so hard over it. And the timeline the author tracks for the single issue is unbelievable.
It stemmed from a joint note signed all the way back in December 1999. The legal battle started in the Madras High Court in 2001.
It finally reached Supreme Court finality in February 2018. That is 17 years of litigation.
Even 7 years after the Supreme Court's ruling, the memo cites PNB retiree Harjit Singh's case as proof that some banks still haven't complied.
And the main issue of pension updating that we've been discussing follows the exact same pattern. It reached the Chandigarh High Court in 2008.
Wow.
Years later, the case still lingers in the Supreme Court. A 2015 MOU promised a review, yet it took bank management a decade just to file an actuarial report.
If central government pensions update automatically with each pay commission, why does the banking sector, guardian of the nation's wealth, depend on 24-year court battles just to secure basic inflation revisions?
Sadly, in the grim reality of institutional conflict, the process is the punishment.
The process is the punishment. That's a great way to put it.
Time itself becomes a weapon. As years pass, aging pensioners lose their claims. The author calls pre-2012 retirees super seniors in the December of life.
Yeah, that phrasing really stuck with me.
For many, the RBI-style compromise is meaningless. They won't live long enough to see the benefit.
They've endured 30 years of frozen pensions as inflation soared. If updates apply only prospectively, those lost decades vanish. The institution simply outlives them.
And as if waiting out the clock wasn't enough, the memo details a secondary issue hitting the slightly newer retirees, the special allowance anomaly.
Right. For the people who retired post November 2012, they are doubly hit.
They face the same lack of pension updates, plus an added anomaly that the memo says directly violates Regulation 35.2.
It also allegedly violates the Supreme Court's Bank of Baroda versus G. Palani ruling, which struck down Explanation C to Regulation 2S subparagraph C.
Hold on, you just threw a massive alphabet soup of regulations and subparagraphs at me.
Let's translate this. What does that actually mean for a retiree's wallet?
The rule was simple: serve 33 years and your basic pension should equal about 50% of your average pay from your final 10 months.
Okay, half your final pay becomes your pension. Simple enough.
Banks added a special allowance, but classified it so it's excluded from the basic pay used to compute pensions, creating the core anomaly.
Wait, really?
Yes. So a significant chunk of the employee's actual compensation is suddenly invisible when it's time to do the retirement math.
Oh, that is brutal.
Shrink the average pay on paper and the pension collapses. The memo says this loophole cuts benefits by 25 to 30%, defying a Supreme Court ruling.
And the author notes this dispute, stemming from a 2015 joint note, is also stuck in the Supreme Court with, quote, only God knowing when it will reach finality.
It shows retirees fighting a two-front war. No inflation updates since 1995 and complex post-2012 deductions that further erode their base pensions.
By contrast, central government retirees do not fight these battles. Their process is automatic and baked into the system.
It forces us to ask a much larger, frankly uncomfortable question about how justice interfaces with capital.
Mehta shows how human lives and institutional litigation run on different clocks. When delays let powerful institutions outlive their creditors, the justice system becomes their bolt hole.
That's all for today's podcast. Thank you for listening, and please comment, like, subscribe, and share on Facebook.